Hey everyone, welcome back to GAF University. I'm Colby Cox, and so today we're gonna pivot a little bit. The last few videos, last few weeks, we've been talking a lot about carriers and their products, and those are great. You need to know those, but carriers and products change all the time. Carriers introduce new products to the marketplace. They take old ones away. They change their indexing strategies. They change their guarantees. They change their benefits, and while that's all important, you need to know it because they're changing all the time. Something that we don't really take into consideration is learning more about concepts. And so we're going to spend the next couple weeks, a few videos here and there, talking more about concepts. Because if you can understand concepts, when somebody brings something new or they make a change to a current product, you can adapt it to those concepts because concepts don't necessarily change over time. Some do, but products are changing constantly. Okay, just yesterday we got an email from one of our carriers that they changed their rates, which means that video may not be good anymore because those rates have changed. Okay, so that's what we're going to focus on today. We're going to talk about term versus perm, so term insurance versus permanent insurance. We're going to see the pros and cons of each, to give you an overview of each, and then why you would use one or the other. Okay, so let's start with term. And pretty simple. A term insurance is set for a certain term period, right? It's usually 10, 15, 20, 30 years. Those are the usual four. You'll have some ARTs in there like American National has or National Life has. Um, there are some carriers out there like AIG that will go all the way up to 35 years. And AIG also has something unique. Well, they'll go 15 to 30, anywhere in between. If you want an 18-year term, they'll do it. If you want a 22-year term, they'll do it. Okay, so there are some carriers that do that. But like I said, for the most part, it's 10, 15, 20, and 30 years. Um, the biggest thing about it is it's cheap. All right. You get it, you're going to pay a much smaller rate because you're pretty much strictly paying for insurance. You're strictly paying for the cost of insurance, and then you're getting your coverage. So you can either get a lot of it and still not pay as much, or you can just go for a really cheap amount, depending on what that budget is. It doesn't build cash. That's not what it's designed to do. It's like renting a home. When you rent a home, and after that rental period's over, what do? You leave. You take nothing. You go. That's it. And that's what term insurance is. So there's no cash. You take nothing when you're done. You just move on. Now, there are some conversion privileges with most terms, if not all terms, and it just depends on the carrier what those privileges are. But you can lock in your rate while you're healthy, and then you can convert it later down the line because when you convert, you don't have to show proof of insurability upon converting. Okay, you just have to pay that higher premium when you convert it to that permanent product. So that's pretty much what a term is. Pretty simple, not much to it. It's straight coverage for the cheap. Now, permanent, there's a lot of different options when it comes to permanent. You can go whole life, which is probably the most common. You have universal life, but then you have different versions of universal life, like index universal life, guaranteed universal life, fixed universal life, variable universal life. There's a lot of different options depending on what your uh, prerogatives are. Okay. The big benefit of it is you always have it. Okay. You get the coverage, you lock in that rate, you have it until 100, 120, whatever the case may be. So you know, no matter when you pass away, you've got that coverage there. You know, no matter when you need living benefits, you got the coverage there. It does build up cash. Not all permanent products build cash significantly, but all permanent products have some type of cash value to it or some type of, um, oh man, I'm totally blanking on what it's called. That's okay. I'm blanking on what it's called, but we'll just keep moving on. Sometimes with permanent products, you have some flexibility. All right, so if you're looking at, for example, an IUL, you might be paying, let's just say $400 a month. You might have a minimum premium of 200 or 210, 220, something like that. And what that allows you to do is have that flexibility that if something comes up, whether it's an emergency or a vacation or Christmas, you could go down to that minimum, have some extra money that month, and then you could go back up the next month. Now, you're not going to want to do that all the time because that's not what it's designed to do, but the flexibility is a huge part of it. In the long run, permanent's going to be cheaper. Okay, obviously it's going to be more expensive upfront because it's permanent. You're going to pay a lot more for a permanent policy than you would a term policy. But remember, with the term policy, you just have to keep renewing it. You got to keep getting it, and the older you get, the more expensive it gets. With permanent, you lock in that rate now, you've got it 20, 30, 40 years as long as you pay it. And then there's sometimes, depending on, again, what type of product you get, where you might be able to stop paying it in 20 years or 30 years or at retirement or whatever the case may be. Okay, so the potential to stop paying it is a benefit of it. Again, not all of them do that, but there is depending on what type of product you get or policy you get, it could happen. It is more expensive up front just because the fees are built in. Again, if depending on how it's structured, we're talking very general today, not specifics, but most fees are built into those first 1, 2, 3, 4 years. Okay. You'll have a 10-year, maybe even a 15-year surrender. So you won't be able to get all that money that you put into it back. But again, if you're getting a permanent, it's designed and you're want to want it for as long as possible. Now, like I said, products change, like I said earlier in this video. So maybe you do some type of replacement or whatnot. But if you're getting a permanent, you're trying to keep that thing for as long as possible. All right. So that's kind of the ins and outs of both term and permanent. Let's talk about the pros and cons of each. Let's start with term. Pros, obviously cheaper. Okay. Whether I'm budget strapped or I just don't want to pay as much for a permanent policy right now, you can go term and it's cheaper. You can get more death benefit. You could be paying, let's just say you're paying $200 for a permanent, you could pay $200 for a term and get a lot more coverage. All right, so that's a positive. You can lock in that rate. If I get a 30-year term and I'm paying $50, I can lock in that $50 for that 30 years. Okay, so that's a huge benefit. And then conversion privileges. That's a huge pro. You can lock in your insurability right now at the healthiest you're going to be, because more than likely, as we get older, we're going to get more unhealthy. Lock in that insurability now and convert it later without proof of insurability. That's a huge pro. A few cons: you always have to pay. If you have term and that's it, you're always going to be paying. And like I said, it's only going to get more expensive as you keep going. Okay, so you'll end up paying more in the long run. You don't keep anything. Your term's done, your term is done. You walk away, you've got no coverage, you got no cash, you've got nothing. Okay, so that's a con. And then here's a big thing that most people don't really understand or don't know, is that less than 2% of all term ever pays out. You line up 100 people, roughly 1 or 2 of those people will pass away during the term period. And why is that? Term is designed, unfortunately, to run out when you need it most. Okay, you take a 50-year-old. A 50-year-old could probably, in some scenarios, get a 30-year term still. That would cover him till 80. But as soon as that person turns 51, the 30-year term goes away. The companies and carriers won't even let you select that 30-year because they know that life expectancy past 80 is not as great. So they change at 51, 30 being the most, to a 20-year being the most you can get. Okay, and that's just unfortunately kind of how term is. If you're 70, you either only get an ART or a 10-year term potentially, and that's it. All right, because it's designed when you need it. It's designed to run out when you need it the most. So while it's great for cheap coverage over time, it's only going to get more expensive. The likelihood of it paying out's not high, and you just don't keep anything at the end when you're done with it. Okay. So now permanent. Let's talk about those pros first. You always have it. Okay, I've got my notes here, so you keep seeing me keep looking down. That's what I'm looking at. You always have it. All right, you lock in that rate, you lock in the death benefit, and you just you have it when you pass away. You surrender it, whatever the case may be. You're always going to have it as long as you pay for it. The flexibility of a permanent policy is pretty huge, and again, it might depend on what type of policy you get, and it might depend on what carrier you're with, but being able to change that premium if need be, being able to change death benefit if need be, is a huge advantage. Okay, I love policies that have flexibility like that. My own policy has a flexibility like that. So what I usually do, what I've done, is in Christmas I'll lower it, and then I'll go back up the next month. That heck, I have enough cash value in my policy where I could even skip some payments, keep that money, and then just restart it. Okay, and I've done that a couple of times. So that's big. The cash value, like I just mentioned, is big. Being able to use that to supplement, using it as a supplemental retirement account, an SRA, depending on if you have an IUL or VUL, whatever the case may be. Being able to use it for an emergency fund, being able to use it for a college fund. Those things are huge benefits of having that cash. That's a huge asset, to be able to say, I've got this cash, and if I need it, it's there. You can lock in that rate. Like I kind of mentioned already, you always have. You lock in that rate. You're paying $300. You got your death benefit. You always pay $300. Okay. And then the functionality of it, because there's so many different types of permanent policies, depending on which type you get, you can use it for specific reasons. Like, for example, American National has an outstanding GUL that has a nice little rider, a cash out rider, that they use primarily, or they promote it primarily as mortgage protection and college funding. All right, because you can cash it out in year 15, 20, 25. So you can get most or all your premiums back depending on how much death benefit you have, depending on how long you've had it. So that could be a huge reason. You might, like I said, use the IUL for an SRA. You might be using the fixed UL just for some coverage with some living benefits for a cheaper cost than a whole life potentially, because whole life is usually the most expensive coverage you can buy. And so the functionality of the different permanent policies is a huge benefit. Now, there are a few cons. Obviously, more expensive. All right, you're going to pay 2-3 times the amount a term would be for that permanent policy for the same death benefit. Okay, usually, not always, but usually they ask for more underwriting requirements. Now, that doesn't necessarily mean they're going to want blood work. I'm not saying that. It just they might ask for more data points from LexisNexis or something. Now, that's not always the case. There's a lot of carriers out there that it doesn't matter what product you get. Just your underwriting is determined by death benefit, okay? And that's fine. But I've seen some carriers, I've seen products where the more coverage you've got in a permanent policy, the more requirements you need. And then one last one is higher fees. Again, depending on what type you have, those fees are usually going to be built in the first 5, 10, 15 years. So you're going to be paying more fees up front, but in the long run, you're going to have more cash value. Again, depending on the type. We're talking very general here. So those are the pros and cons of each. And the last thing I'm going to do is talk about why would you get a term? Why would you get a permanent policy? Okay, because I like both. I have both myself. But there's reasons why you might want to get one over the other. Okay, so why would you get a term? Obviously, because of price. I mean, it is cheaper. So if you're budget strapped, or maybe you need more coverage because you just got married, or you just had a kid or two, and maybe you already have a permanent policy, but you want more, but you don't want to pay the permanent price, so you get a term. You could use term for buy sells. All right, maybe you've got a business partner, maybe you own a business and have a partner, and you both want to get coverage on each other in a buy sell agreement. That can be used for a term. Maybe you own your own business and you're going to get a loan and you need more collateral for that loan, so you get a term policy to cover the amount that loan amount is. We've done that before. Another reason why you get a term is to lock in insurability now. Okay, so if you lock in your insurability now and 20 years later, something happens, you get injured or sick, you don't have to show proof of insurability at that moment. You've already locked it in at the earlier time frame. You just convert it and pay that higher price, okay? So that might be another reason why you get a term policy. Now, why would you get a permanent policy? Because you want to lock in that rate. I'm telling you, if you're in your teens or your 20s, heck, maybe probably even your 30s, you might want to just go permanent because it's going to be cheaper than waiting 5, 10 years down the line, okay? So you want to lock in that rate. You want to keep that $100, $200, $300, $400, $500 a month that you're paying, and you want to keep that rate like that. You don't have to pay more for that same amount of coverage in the future. So that'd be a reason. The cash value obviously is a huge reason. If you want additional benefits of cash value, you've got to go permanent, because again, term doesn't do that, right? And so you've got to go permanent policy, have that cash value as the emergency rainy day fund, whatever the case may be. Like I mentioned earlier, the flexibility of it. And again, I'm talking about myself, I have an IUL. I've got that flexibility to go back and forth between the full premium that I'm paying and the minimum. Now, there's pros and cons of doing that because of how the IUL is structured, but the ability to do that is what is a huge benefit. I mean, we've had clients where they've had their policy 10, 15 years, and they stop paying for 2 to 3 years because something happens. And in 2 to 3 years, they come back and they find out that their policy is still in force strictly because they had enough cash value in it. All right, so the flexibility of that is huge. And like I said, the functionality. If you're looking for the functionality of a permanent policy, you can use it for mortgage protection, college funding, supplemental retirement, buy, sell, executive bonus, premium finance. Got to have a permanent policy for premium finance. All of those things are huge benefits. And so if you're looking for that, if you're looking for additional benefits than straight protection, you've got to go with the permanent. Now, like I said, I've got both. If you ask my opinion, I'd lean permanent because I'd rather have the policy forever. Less than 2% of all term ever pays out. The only reason I have a term is because my wife and we had a child. I wanted more coverage. I just don't want to pay that price right now. So I'm going to lock in my insurability now. And then 2 or 3 years down the line, okay, now we'll convert. And that's what I'm going to do. But that's really it. That's the difference between term insurance and permanent insurance. But if you have any questions or you want to add anything to this discussion, put in those comments below. Make sure you send us a message. Subscribe to our channel for sure, because we've got more of these concepts coming out over the next few videos. You all have a great day.